Hello everyone and welcome back to these sessions on financial reporting. In this class of financial reporting, we are continuing with the main topic financial instruments. We are within Ind AS 109 and in this class, the entire dedication is on this heading embedded derivatives. Something very important and something that students find it little complicated. Believe me, it is not. Embedded derivative. Let us break down this term into two independent words, that is embedded and derivative. The term embedded indicates something that is attached to or is a part of. So something that is a part of, something it is attached to something, we use the term embedded. On the other side, the next term, that is derivative, you know very clearly the meaning of derivative. Derivative is a contract that is expected to be settled at a future date and it derives its value from the value of the underlying. So derivative, if you know the definition of derivative, any contract which is a derivative, which is a part of another contract which is a host contract, then this attached derivative can be considered as embedded derivative. So let me give you a few examples to clarify what is embedded derivative and what should not be considered as embedded derivative. Simplest example could be an example of convertible debentures. Suppose I am a company issuing convertible debentures and you are the holder of these convertible debentures. Now what is the nature of this contract if I explain? I have given you debentures of the face value rupees 1000. Each debenture is convertible into 5 equity shares of my company. Now if this conversion is made as a compulsion, it will be classified as compulsorily convertible debenture. In that case, the holder does not have any option. The holder does not have a choice. Then we don't call it a derivative. On the other side, imagine if these were optionally convertible debentures, where the holder of the debenture instrument is having a right to convert these debentures into equity shares of the issuer. That means, if I elaborately explain this example, the face value of the debenture that I have issued to you is rupees 1000. Each debenture is convertible into 5 equity shares of my company. Now this conversion is at the option of the holder and the option exercising date is exactly at its maturity of 5 years. So if the holder does not exercise the option of converting these debentures into equity shares, then the issuer of the debenture, that is me, I will be under obligation to redeem these debentures by a cash payment. So if I have issued a convertible debenture to you, you are the holder of convertible debenture. This convertible debenture is convertible at your option, at your choice at end of 5 years from the date of issue. There is no compulsion upon the holder. If the holder is not willing to let these debentures convert into equity shares, then the holder can claim the cash redemption and issuer of the debenture, that is myself in this example, I will have to give you that 1000 rupees back. So the redemption will be at par if the conversion option is not exercised. I believe this example is set in your mind. Now what is embedded derivative in this example? I am coming to that point. But let us first understand why there is a derivative included in this example. See, this conversion option is typically a derivative. Let me explain why it is a derivative. You see, imagine the date on which these debentures are matured for redemption, that is after 5 years from the date of issue. Just imagine that equity share of my company is having a quoted market price of 320 per share. Now you as a holder of the debenture, you have a choice. You can surrender your debenture and claim the conversion of one debenture into 5 equity shares. One equity share having a market price of 320. If I give you 5 equity shares, the total value in your hand will be 320 multiplied by 5 equity shares, that will be rupees 1600. So you surrender a debenture and claim from me equity shares worth rupees 1600. Otherwise, the other choice is what? You can claim cash redemption at par. In that case, I give you cash, just rupees 1000. Choice is yours. Obviously, you will not make a wrong choice. It is expected that you will be making the right choice, which will be exercising the conversion option. That means you will claim the value of 1600 rather than claiming the cash redemption of rupees 1000. So if you are then not interested in being the shareholder of this company, you can sell out those shares in the open market and you can get that money in your pocket. However, just imagine if the market price of these shares was just rupees 160 per share. Then 160 per share multiplied by 5 shares, the total value that you would have obtained on exercising the conversion option would have been rupees 800 only. 160 multiplied by 5, 800. So who is going to sacrifice a cash redemption, that is a right to receive cash of rupees 1000 for just those 5 equity shares where you are having the market value of those 5 shares taken together just as rupees 800. Between 800 and 1000, anyone will pick 1000, correct? So understand one thing. You being the holder of this debenture, you have the right to claim the cash redemption or the right to exercise the conversion option completely at your choice. Now, if you closely observe this option, which we are calling as conversion option, it is indeed a call option. You know what are call options? Call options are option contracts which provide the holder right to purchase shares, and the party which is under obligation to sell the shares is the counterparty who is the writer of the option. So in this case, I am writer of that call option, you are holder of that call option, because you have the right to purchase equity shares of my company as per that contract. So when you say that you have a right to get your debenture converted into equity share, I would precisely call it as a call option, because you have a right to buy my equity shares. By surrendering that debenture and exercising the conversion option, you are actually exercising a call option. So again, going back to the original information that I gave you, that imagine the market price of equity share of my company on the maturity date of that convertible debenture is rupees 320. Now, once again, as the holder, you have a choice. You either take from me a cash redemption of rupees 1000, or you take from me 5 equity shares where each has a market price of 320. So what will you choose? Obviously, you choose the conversion option. So I am telling you, if you just dissect the whole thing, it is actually a call option. Why? Because otherwise you would have got cash of rupees 1000. That means I am giving you 5 equity shares for just rupees 1000. That means you can buy 5 equity shares of my company by exercising your option of buying these shares at just rupees 200 per share, because you are sacrificing rupees 1000 for getting these 5 shares. Isn't it a call option? A call option is an option where the holder has the right to buy shares from the counterparty. So you have a call option which is attached to the host contract. So here this call option is a derivative which is attached to the host contract, which is debenture. So look at one thing, there is a hybrid contract or a hybrid instrument. So this convertible debenture that I have issued to you, that convertible debenture as a whole is a hybrid contract or a hybrid instrument. The debenture, purely the debenture, which gives you contractual cash flow characteristic, correct? That debenture contract is the host contract, and to that what is embedded is a derivative, that is a conversion option, which I am calling here as a call option. So you try understanding this one thing, that the host contract is that debenture, to that we have attached a conversion option which is an embedded derivative. Host contract plus embedded derivative taken together is called hybrid contract or hybrid instrument. So three terms I want you to fit into your minds. In this example where I am issuing convertible debentures to you, the whole convertible debenture will be classified as hybrid contract from the viewpoint of the holder. Just recall one thing, few lectures back we have learnt concept of compound financial instrument. From whose viewpoint did we classify a convertible debenture as compound financial instrument, segregating that into one portion as a liability component and one portion as the equity component? That was from the viewpoint of the issuer of the instrument. Here we are talking from the viewpoint of holder of the instrument. We will call this whole convertible debenture as hybrid contract. So issuer of this convertible debenture is identifying something as a compound financial instrument, segregating that into liability component and equity component. The holder of this instrument, that is you in this example, will identify this convertible debenture as a hybrid contract, and you will not separate this into debt and equity or liability and equity, because for you it's an asset, right? You will segregate this into host contract, and to that there is something attached which is a conversion option. So debenture contract is the host contract, the attached conversion option is embedded derivative, and the entire instrument as a whole is hybrid contract. Now this is the meaning of embedded derivative that I have conveyed to you. Now you should understand typically what should not be considered as embedded derivative. Suppose I give you an offer. So my business is typically selling these video lectures, right? That is typically my business. So if I give you an offer that whoever buys this typical video class from me, I will give that person a share warrant which entitles you to purchase 5 equity shares in my company at a price of rupees 200. On that share warrant, I mention the holder of this contract is entitled to purchase 5 equity shares in NJ Limited. NJ Limited is the name of my company. So 5 equity shares in NJ Limited at a price of rupees 200 each. So you want to exercise that warrant, that right. You know, share warrants are share rights. The word warrant itself means rights. So when you have share warrants, means you have right to purchase the shares from the issuer. Now if you exercise that right, I will have to issue 5 equity shares of my company at a price of rupees 200, just like the convertible debenture having that conversion option. Here there is nothing getting converted. You will pay cash and purchase those 5 shares. Now this share warrant is given along with my video lectures, but anyone who is holding that contract can come to me and purchase those 5 equity shares. That means that person may not necessarily be you. In other words, you may transfer that share warrant to any other party. Any other party holding that contract, independent of whether they have actually purchased my classes or not, can simply exercise that option and purchase those shares from me. That time, that derivative, which is a share warrant or a share right, which is also a type of call option, need not require a host contract for its settlement. On the other side, try applying this separation in case of the convertible debenture. As I told you, you try to detach that conversion option from the convertible debenture and you give that conversion option to somebody else. Let that somebody else come to me and say that I want to exercise the conversion option. What will I say? Fine, you exercise the conversion option, but for exercising the conversion option, you have to surrender that debenture and then take 5 equity shares from me. Please bring that debenture and you have to surrender that instrument. In lieu of that, I will give you those 5 equity shares. That means without the presence of the host contract, the derivative cannot be settled. Then it is called embedded derivative. When there is a derivative attached with something which can be detached and settled without the host contract, that is not an embedded derivative. 2 examples I gave you, 2 examples. Example number 1, convertible debenture, where the host contract is the debenture contract, embedded derivative is the conversion option, and the entire instrument is called hybrid contract or hybrid instrument. Second example I give you, that the host contract is a contract of sale of goods. I am selling goods to you. Attached to that is a share warrant. But that share warrant is not an embedded derivative, because to settle that contract of derivative, you do not require the presence of the host contract. That is where it's a derivative attached to another contract and which can be detached and traded independently or settled independently without the host contract. Then it is not an embedded derivative. I'll give you few more examples to understand what is embedded derivative. Let me give you another example. Imagine that I am a bank and you have approached to me as a borrower. It's a big amount of loan that you want to borrow. Say 100 lakhs of loan you want to borrow from me. I am a bank, you are a borrower, you want to borrow 100 lakhs. Now, you have a possibility of getting a huge amount of cash flow in 3 years' time. It is not certain, there is a possibility. In that case, if that happens, you would want to settle out your loan, right? Why should you keep yourself under that obligation of borrowing? If you have money in your pocket, you should be able to square off that loan. But then the loan contract should give you liberty of settling the loan earlier than its maturity, what we call as prepayment. So you have asked for a prepayment option and I have given you that prepayment option, but with one condition, that the usual interest rate prevailing in the market is say 12% per annum. I give you a loan at 13% per annum, and if I give you a loan at 13% per annum, that time you have a choice of settling your loan, making a prepayment and squaring of your loan at any point of time. Of course, there will be some additional penalty to do that. Say I charge 2% penalty for prepayment option that you are exercising. So 2 different components of extra expense you have to incur. You have to bear a little higher interest rate for getting that prepayment option, and when you exercise the prepayment option, you have to pay additional penalty, but still it is giving you an option, right? So that prepayment option is a derivative. Why it is a derivative? Do you know? The underlying over there is interest rate. Just imagine, you borrowed at 13%, right? Suppose after a few years of borrowing, the interest rate prevailing in the market goes down. It goes to 9 or 10% per annum. Then it makes sense that you make a fresh borrowing from somewhere else and repay the loan that you have taken from me. But in that case, you should have the choice of repayment, the right of prepayment, the option of prepayment you should have. So if the interest rate prevailing in the market rises to 14% or 15%, you would not want to exercise your prepayment option. You would be happy paying interest at 13%. What is the worth of that conversion option, or what is the worth of that prepayment option in that case? The worth of that prepayment option in that case would be negative. However, if the interest rates in the market are getting lower and lower, then the prepayment option is getting some value. So what is the underlying in this whole arrangement? Interest rate. So it's an interest rate derivative where you have option of making a prepayment. If this derivative is attached to this loan contract, the loan contract is the host contract, this prepayment option is an embedded derivative, and the entire contract will be a hybrid contract or a hybrid instrument. Now try detaching this prepayment option. Suppose you sell this prepayment option to someone else, that someone else coming to me, I am a bank, someone else coming to me and telling me that, boss, I want to exercise my prepayment option. I said, fine, pay that penalty of 2% and please give me back 100 lakhs and your loan is closed. You cannot exercise that prepayment option without the loan contract, right? It cannot be detached and traded independently as a derivative. It is a derivative, but it is the part of that host contract. It cannot be detached from the host contract and traded or settled separately. From accounting viewpoint, you may account for that embedded derivative separately, correct? But from settlement viewpoint, you cannot settle it separately. That is why it is called embedded derivative. I'll give you one more example. Suppose you are exporter of certain type of goods. You are an exporter of certain type of goods. You have made an export and the counterparty will be making a payment in foreign currency, that is US dollar. You are an entity operating in India. Your functional currency is Indian rupee, but you have a choice to receive the payment in US dollar. What happens now? This contract is basically a contract of sale, but when it is settled, you will be receiving the payment in US dollar. In that case, just imagine the money that you are going to receive, I repeat, the money that you are going to receive is in the form of US dollar, and the converted value of that US dollar into Indian rupee, that is your functional currency, could be less or more depending upon the exchange rate between USD and INR on the date of settlement. Now this is not an option. Suppose this is not an option, you are going to receive that amount in US dollar. Then it is typically a kind of forward contract where you are going to receive US dollar and you can convert that into Indian rupee. So if the price of US dollar increases, that price will fetch you more monetary value in terms of Indian rupee. If the price of US dollar declines, it will be a shortfall in your overall revenue. Yes or no? Now your final amount of recovery is dependent upon the price of US dollar. That means the contract where the settlement will happen in US dollar, isn't it a derivative because its value is dependent on the price movement of the underlying, which is US dollar in this case. So you try to carefully observe, here also there is a derivative involved in that settlement. That contract of receiving USD as a mode of settlement is the derivative, and the sale contract was the host contract. Now this is yet another example of an embedded derivative. So I have given you a few examples mentioning clearly where you would find an embedded derivative and where you will not find an embedded derivative. Once you identify that in a contract embedded derivative is present, then the next step arises how to account for that embedded derivative. The standard has made something very clear. You just first observe the nature of the host contract. If the host contract is a financial asset, if the host contract is an asset within the scope of Ind AS 109, that is the language used in the standard. If the host contract is an asset under Ind AS 109, that means if the host contract is a financial asset, then embedded derivative shall not be accounted for separately. The entire hybrid contract will be placed for one type of classification, and that one type of classification will be at fair value through profit or loss. In that case, the standard does not allow you to account for embedded derivatives separately as compared to the host contract. The whole contract, that is the hybrid contract, will be accounted for by placing the whole instrument into FVTPL category, that is a financial asset carried at fair value through profit or loss. So just put this into your mind very clearly. If the host contract is a financial asset, then the embedded derivative shall not be accounted for separately. The whole instrument will be placed into FVTPL category. Matter ends. However, if the host contract is not a financial asset within the scope of Ind AS 109, then there is a possibility of accounting for that embedded derivative separately, provided certain conditions are fulfilled and certain conditions are considered. We have yet to talk about those conditions. I am going to explain you those conditions in detail, but if I speak about that thing right away, you may get confused. So let us put that discussion of those conditions little later.